Hi, welcome to your next market update. As a member of the CalendCharts.com family, we're glad to do these on an ongoing basis. So we'll start with the S&P, and let me show you kind of some stuff I have here. I like using Bollinger Bands to gauge if the market's overbought or oversold. I look at a 20 and a 50-day moving average. A 20-day is the blue line, and the 50-day is the red line. And to me, a longer-term trend is higher if the 20 is above the 50. Also, with Bollinger Bands, for those familiar with it, the 20 period moving average is usually the normal moving average for the Bollinger Bands plus and minus 2 standard deviations. Anyway, what I've done here, first of all, we could see, not surprisingly, the 20 is above the 50, so the intermediate term trend is strongly up. And I drew a couple of green lines here. These are actually parallel lines. Many times during a rally or sell-off, for that matter, the market's in a channel, and you could actually see it with parallel lines, which can become support or resistance. So here we have a rising support line, and a parallel line is here, and you can see how it kind of became a resistance area. We can make a little shorter-term resistance line if we mentally draw it in. I don't have my drawing tools on, but you can make a resistance line kind of up here. But what I like about the action in the S&P, it's almost a 45-degree angle, and that's a very sustainable rally. During the height of the bull market in the 90s, when the markets were going parabolic, we were having like 75-degree angled rallies, and you know that's not sustainable. But what's nice about the recent market action also is what I'm drawing here in the blue lines. One of my favorite Western indicators is essentially an old resistance area becomes potential support. So we can see an old resistance zone is support. This recent resistance zone from earlier February has become support recently. So this is a very healthy way for the market to rally. It's kind of self-correcting, although we've been riding the top end of the Bollinger Band. To me, really the market is not overextended because the market rallies and trades sideways for a week or two, then rallies for a few days, and then trades sideways. So it's kind of a self-correcting market, which is quite sustainable. So I am still bullish longer term. The issue, however, and it's something, sorry, didn't mean to do that. It's something to be aware of. I want to show you the weekly chart on the S&P. So in the blue arrow here, we have a dark cloud cover from, looks like last April. And then we have a series, another bearish engulfing pattern over here, a series of bearish candles, black wrapping around this high wave candle. This is not an evening star, by the way, because this black candle didn't get more than halfway into the white candle. But nonetheless, it is a bearish engulfing pattern. And then another bearish engulfing pattern. So the two green horizontal lines defines a strong important resistance area. However, we do not have any bearish reversal signals yet. Yes, we have a couple of small real bodies. Of course, this is only through Tuesday, this little real body, but last week we got a small real body, but still the market is making higher highs and mainly higher closes. So the trend is still up, but just want to give you a heads up that although the trend is up, if we do get any bearish reversal signals on the weekly chart, which means we need a Friday close, around 1375 or so, it could be time to take profits for those who are long. In fact, for those who are long, although we don't have any bearish candlestick signals, no reason not to take some profits here. And I'd probably scale out of pretty much everything, or even do a bear option trade if we get a bearish candlestick signal. Now, let's move on to the pound dollar. And before I start on this Forex market, I want to thank those who were nice enough to participate in our surveys. We did a few surveys over the last couple of months as I prepare for my new FX seminar. We'll give you details about it over the next couple of weeks. But your feedback on the surveys about your challenges in the FX market and things you would like help with, as well as a weekend seminar if you'd prefer it on a Saturday and Sunday, or two consecutive Saturdays, really will help us a lot as we prepare this seminar to best meet your needs. So thanks for the input on that. Oh, before I go back let me go back before I talk about the euro, the pound dollar, because I do want to mention, if the market does get a weekly close above 1375, I just want to give you a heads up that my next target would be the highs that the S&P made back in 2007 at 1575. So I did want to mention that. So let's get back to the pound dollar. And this is one of my favorite trading vehicles, box ranges. The market is at the top end of a box range, defined by this resistance zone, by the two blue lines here, and a support zone over here, the morning star over here, a piercing pattern over here, a bearish engulfing pattern over here is defining resistance. So the way I like trading box ranges is thinking about selling at the top end of the range with a target at the bottom end of the range, or, as the case here, if we get to the bottom end of the range, to buy it, looking for a return to the top end of the range. Of course, we always have to think about risk reward. Now, if the market does break outside of the box range, not only do I like it because it gives us targets, but if it breaks outside of the box range, I should say not only do I like it when we trade within the box range because it gives us targets. If we stall at the upside of the box range, the target is the downside. If the market rallies from the downside, the target is the upside. We also get targets on breakout. So if the market breaks above I'd say the high here around 159.50, my target would be up at around 162, essentially taking the height of the box range, really taking kind of the middle of the resistance area here down to here as the height of the box range. And coincidentally, 162 are the highs made back in November, which would be my next resistance area on a close above 159.5. And on the flip side, if the market closes under, let's say 156, once again, we take the height of the box range, add it to the breakdown point, and that would give me a target at around 153.50. Because the major trend is up, the 20 is above the 50, the odds slightly favor a breakout to the upside rather than a breakout to the downside. Now, let's look at crude. Interesting stuff going on here. We have a resistance area. I should draw this a little better, but it's connecting the highs over here. So we have a resistance zone. We had a resistance zone from around 102 to 103. The market closed above it, and to me, more importantly, it gapped higher. Look at this rising window in the green arrow. This really is a support area, and we can see how nicely this little support zone. I like really small rising windows because you have a tight support area as compared to large rising windows. So notice how the support level held. So there's two zones of support at the rising window, around 104, and then there's change of polarity, old resistance becoming support at 102. And yes, the market had a bearish engulfing pattern on Monday, and that's part of the reason it sold off today. I'm doing this later in the day on Tuesday. But my feeling is anywhere from 104.5 down to around 102 should be a really good support area. Resistance 110, but my longer term target, as shown on the weekly chart, is this I should say resistance area set by the dark cloud cover and this huge, this is an absolutely classic bearish engulfing pattern. Look how much bigger this black candle was than the white candle. So the high of this bearish engulfing pattern in dark cloud cover is right around 115 actually, 114 to 115, and that is actually my target. Looking for major support. As I mentioned before, from the rising window, you can even see it on this weekly chart down to the change of polarity. Now, also what's interesting is this ascending triangle. That's when we have horizontal resistance and higher lows, in other words, an ascending support line. And we could use this to get a price target. We take the height of the triangle, so it's about $10, from about 92 to about 103, actually $11. Add $11 to 104, and you get a target up at 115, which coincidentally is the major resistance area up here. Have a great week, everybody.